Hello and welcome to Rush Hour. I'm Ankur Mishra, your one-stop destination for all the news from global to local. And let's get started with August US CPI. Annual inflation has risen to 2.9%, in line with expectations of 2.9%, while their core CPI inflation increased 3.1% YOY, matching the forecast for a gain of 3.1%. On the monthly basis, also the numbers met street estimates, as US CPI came in at 0.4% versus expectations of 0.3%, while US core CPI came in at 0.3% versus estimate of 0.3%. US weekly jobless claims saw a jump coming in at 2,63,000, which is higher than 2,35,000 estimate and up 27,000 from the prior period. My colleague Rabinder is joining with a roundup of the data which has been released by US. Rabinder, over to you.
Well, yes, US August CPI rose by 0.4% in August, doubled down the 0.2% rise in the July month, and this pushed the annual inflation rate to 2.9%, which was in line with the economist's expectation of 2.9%. And the core CPI, which excludes food and energy price, rose 0.3% for the month and 3.1% year-on-year basis, both matching the forecast. And remember that yesterday US PPI was below the estimate, but today CPI has come in line with the estimate. And if we look at some of the earlier trends of the US CPI, then in July US CPI held at 2.7%, though softer than 2.8% projections, and in June it rose further to 2.7%, slightly above 2.6% estimate. And in May, inflation edged higher to 2.4% as compared to April month, exactly in line with the expectation. So on back of this US CPI, the 10-year Treasury yield dropped to 4% after inline core inflation, and US indices opened slightly in higher.
Yes, definitely. The stock markets are reacting to the numbers which has been posted by US as far as CPI is concerned. But to discuss this data in detail, we have with us Andrew Freris, CEO of Econogenesis Advisory from Hong Kong. Andrew, welcome. My first question to you: how do you interpret the latest data which has been released of US CPI? And also, in comparison, PPI was much below estimates. But what do you make out of CPI data?
Here I am. I'm the candidate for the Nobel Prize in Economics. Okay, so I'll say it loudly. Inflation is accelerating. Hello? Inflation is accelerating. What else can I tell you? All the numbers are up. If I look them from April, okay, you just already said them. The CPI 2.3, then 2.4, 2.7, 2.7, 2.9. The core, again, starting from April, 2.8, 2.8, 2.9, 3.1, 3.1. The CPI that the Fed likes it, 2.2, 2.4, 2.6, 2.6. Inflation is accelerating. What am I going to tell you? The Fed presumably will need to take that very carefully into account, except of course they have the very poor numbers of employment, and in particularly the jobless claims, which we've just seen, are actually the worst in 4 years. So, if you're asking me if I was the Fed, I will not cut rates. But the Fed will need to cut rates, okay, because they're under pressure now that the economy is not doing very well in terms of the labor market. But at least inflation is absolutely clearly accelerating, is not coming down. The impact of input duties have not yet been passed through. It has been very slight and little, but this is very much passed with both expectations and what has happened in the past. In other words, prices just don't simply jump up because you put a 50% input duty on certain goods. So I'm going to stick my neck out. Okay, if you are asking me what the Fed is going to do, well, I think they are under tremendous pressure to cut interest rates. I think that will be a very bad move, really very poor move, okay, because the cuts in interest rates are going to take quite a while to impact the labor market, but they will have a much faster impact potentially on demand and on potentially, of course, on the stock market. And the stock market is completely crazy. It's the highest it has been. Okay, they are now like children. They are waiting for the cut for this to go further up for no reason whatsoever, given, of course, that the economy is doing poorly. I know it is a very crazy world. And I refuse to play with expectations and simply look at my numbers and I'll say the labor market is doing poorly, the inflation is accelerating. If you cut interest rates, the only thing you're going to do is you're going to accelerate even further asset inflation. And you're going to see that the bond markets are going to jump. They are not going to like it a bit with inflation accelerating. And I imagine Mr. Trump will be very happy with lower interest rates and even incredibly unhappy with a lousy
Right.
labor market.
Right, Mr. Andrew, I like the analogy which you have drawn. Stock markets are like children, but the father of the children have already spoken about it many times, and latest being yesterday, saying that Fed will have to cut rates. Now, politics and policies should be separate in an ideal conditions, but as you are mentioning, there is a lot of pressure on US Federal Reserve to cut rates this time. While you are maintaining they should not, do you think the anticipation of 0.5% cut is right?
Okay, let me make it as easy as possible. You know, what I think is of no consequence whatsoever. I'm a little economist here in my armchair in Hong Kong. Nobody's going to listen to me. Okay, so I'll try to tell you what I think is likely to happen. The Fed is likely to cut interest rates. I think that's a terrible move. And I've already been advising my clients not to buy US stocks. Okay, because we know exactly what's going to happen. The markets are going to jump. They are going to jump on the basis of an economy who is doing very poorly, at least if we're going to look at the labor market. And if, as I expect, inflation will continue to accelerate, all this is going to end up in tears. Though I don't want to be anywhere near American stocks, never mind artificial intelligence or technology. If the Fed cut interest rates, forgotten now when it is on the 17th or the 18th. So it's very simple. That's my prognostication.
Right, and you're mentioning about inflation. What makes you think that the data which is currently available for everyone to see, it is showing that yes, it is in line with the expectation, at least in line with the expectation of the market, and PPI has been slightly better than the anticipation. Now, what makes you think that inflation is going to inch higher from here?
As an ex-academic, I really trust and believe what my academic colleagues have been doing. And in the case of the United States, all the information and the academic work that has been done on the impact of tariffs on American inflation in the last 20 to 30 years points to one thing and one thing only. In general, prices eventually reflect anything between 50 to 100% of the increase in the tariffs. Ta-da! It's as simple as that. The Americans are not going to escape from that. It might take perhaps another 3 or 4 months. Okay, it might vary, of course, a great deal. It is also, if you think the tariff policy of the United States is a joke. What tariff policy? Now, Trump decided that they are going to put not only higher tariffs on India because of the Russian oil imports, but they're going to do the same thing with China. I thought they had just about finished the negotiations. So the whole thing is a joke. So in other words, what is the tariff level in the United States is nobody knows. Well, nobody knows. You can look at the numbers, but they're going to change again. And of course, this is amazingly bad for confidence because for sure, Trump is not going to remove the tariffs. Eventually, he will have to, but for the time being, he's not going to remove, and still we are uncertain as to the actual increase. Well, look at my finger. Whether it is 1% or 100% increase in tariffs in a class of goods, invariably consumer prices will go, watch my finger, they will go up. By how much? The evidence in the States, as much as 100% or as well as 50%.
Point well taken, Andrew. But the larger question here is that next week, if at all Fed cut rates by 50 basis point, you have mentioned that markets may go up, but do you think that will be the peak of the markets? And as you mentioned that if inflation is inching, the effect of tariffs will be visible. Eventually, everything will align with the larger economy?
No, of course not, because if the Fed, God help us, cuts by 50 basis points, it indicates that they are genuinely very concerned about inflation. And therefore, they are likely to cut again. If the Fed was to come up and says, look, we're going to cut 25 basis points, and that's it. We're going to wait for 6 months before we take another step, I think that will be acceptable. But they're not going to do that. Okay, I think they will simply cut and they will somehow something or another. It is not, I don't think they're going to do it because they're under pressure by Trump. Now, the composition of the Fed is changing. And remember, you have 12 people. The idea is that simply Powell goes into the board and says, look, we're cutting interest rates. Bye-bye, I've got to go home now. No, they take a vote. They need 7 out of the 12 to say, yes, we're increasing interest rates. You know, Trump tends to forget that. He thinks that Powell is God, like he is with all other things. Powell is not God.
Definitely, that is the thinking, and that is the way actually Donald Trump operates. But you would have also seen the output output announcements by OPEC and the impact on the crude recently. It has remained largely in line. But you think that in coming months, even crude prices are also likely to inch up?
I'm afraid I'm going to be like an economist. I'm going to tell you it depends, and I hate that. But I think on average, it is it is unlikely because the Europeans will have to do something about Russian oil. And therefore, if they stop buying, of course, Russians will have to sell, and that's going to push the prices down.
All right, that's the word which is coming in from Andrew Freris. Thank you so much for joining at this hour with your views and making your point amply clear that what is the expectation, but what you think is right.